Okay, let's dive right in. Have you ever, looked at a bill or maybe your receipt, even your bank statement, and just wondered, what is really going on behind the scenes there?
Hmm.
What if I told you that pretty much every financial thing you do day to day, it's part of this really complex system that honestly most of us don't even know exists?
Right.
So today we're taking a deep dive into the fascinating and sometimes, well, pretty unconventional world of commercial paper. We're looking at how it might be quietly underpinning the flow of your money.
Yeah, and we're drawing from some specific sources here, like one titled Commercial Paper, The Good, the Bad, and the Corrupt, which definitely offers a, let's say, less conventional take on these systems.
Exactly. So our mission today is to help you understand not just what these instruments are, promissory notes, Federal Reserve notes, all that stuff, but why they matter, according to this perspective, to your everyday financial life.
What's really foundational here is how these ideas, these concepts, they operate mostly out of sight, right? But they shape so much. We want to, pull back the curtain a bit on these financial instruments, give you a shortcut to being well-informed on this particular view.
Get ready to look at your bills and statements with maybe a new set of eyes. Because once you grasp these mechanics, as our sources lay them out, your whole perspective might just shift.
It's definitely food for thought.
So let's start with the main player here, commercial paper, CP.
Right.
CP. At its core, our sources describe it as a negotiable instrument. Think of it like a fancy IOU.
Like a promise to pay.
Exactly. Like a promissory note or a draft, a bill of exchange, something that can be easily bought, sold, transferred between parties.
Okay.
And its importance, according to these materials, really ramped up in the U.S. after 1933, when gold was taken out of circulation.
That's a key point in their narrative.
Yeah. At that point, commercial paper, as they tell it, essentially became the backbone of American commerce. And here's where it gets really interesting. This shift, they argue, meant that true payment, like paying with actual gold or silver, was pretty much replaced with credit in almost every transaction.
That's a huge distinction they're making. The idea is that almost every transaction you make today, groceries, rent, whatever, it ties into this bigger web.
A web of what exactly?
Well, of commercial paper, UCC Commercial Law, that's the Uniform Commercial Code, the rules for this stuff in the U.S. banking, coupons, securities, bonds, it's all connected in their view.
Wow.
And the sources get specific about CP's characteristics. Typically unsecured, they say, meaning it's not directly backed by like a house or a car in the traditional sense.
Okay, unsecured. What else?
Short term, usually maturing in 1 to 270 days, often around 30 days is typical.
So quick turnaround.
Right, and it's often issued at a discount, paying a fixed interest rate, though that rate can fluctuate. And here's a detail they highlight.
Yep.
If it matures within that 270-day window, it doesn't always need to be reported to the SEC, the Securities and Exchange Commission.
Okay. And they see that as significant.
They suggest it's a key aspect, yeah. Enabling a lot of this behind-the-scenes financial activity, as they put it.
Okay, so let's make this a bit more concrete. What are some examples they give?
Sure. Well, they mention things like payroll, the money you actually earn from your job.
Right.
Inventory, too. Think about, all the cars sitting on a dealership lot. That inventory might be financed using commercial paper.
Okay, that makes sense.
And even legal documents, like warrants, are interpreted as a form of commercial paper within this specific framework.
So what's the takeaway for someone listening? What does this mean for you?
Well, the implication from these sources is that your daily work, buying a car, even interacting with the legal system, it's all deeply rooted in this commercial paper system.
It's everywhere, basically,
Right.
according to this view.
Pretty much, yeah. It's pervasive.
Which leads us to something else fascinating and maybe a bit mind-bending for some. Federal Reserve notes. FRNs.
Oh, yes. The cash in your wallet.
Exactly. Section 16 of the Federal Reserve Act, that's 12 U.S.C. 411, it says FRNs are obligations of the United States.
Right. Obligations. Debts, essentially.
And they're issued, it says, at the discretion of the Board of Governors of the Federal Reserve System for the purpose of making advances to Federal Reserve banks and for no other purpose.
Yeah, crucial phrase there. No other purpose.
And they're technically redeemable in lawful money on demand at the Treasury. Now, lawful money, that term itself has a history, right?
It does. Before 1933, the sources point out, that generally meant gold or silver coin. After 1933, when gold backing was removed, well, The definition effectively circled back onto FRNs themselves.
Creating a sort of loop.
Exactly.
Now, here's where our sources present a really provocative interpretation.
Okay.
They suggest that FRNs are only authorized for Federal Reserve agents in the Buck of Governors, not for you and me walking around.
Right. That's their specific reading of that section.
So the implication, according to this view,
Yeah.
it's pretty startling. They ask, if you're using these notes for everyday payments, are you, in their words, kind of impersonating someone authorized to use them? What are the potential legal issues?
Yeah. It's definitely an unconventional concept they put forward, a challenging idea.
So what's the practical meaning of that, according to them?
Well, the way these sources explain it, using FRNs for your personal transactions means you're trying to pay a debt with another debt.
And you can't do that.
In this system, they argue, one debt can't discharge another. It just shifts it. They contend FRNs were primarily created for things like international treaties or bailing out other countries.
Ah, okay. So when you hear about money being sent overseas,
their perspective is that that's the FRNs being used for what they see as their original intended purpose, not necessarily direct taxpayer dollars in the way we might think.
it all seems incredibly tangled up together when you follow this logic.
It does, and the very process of issuing FRNs reinforces this connection to commercial paper.
How so?
Federal Reserve banks, when they apply for FRNs from their local Federal Reserve agents, they have to back that application with collateral security.
Right. Collateral. Like,
Notes, drafts, bills of exchange, acceptances, in other words.
commercial paper.
Exactly, commercial paper. It reinforces their idea that at pretty much every level, it's all flowing through this commercial paper system.
Okay. Prepare for some more, let's call them aha moments, or maybe moments. Because we're about to explore how, according to these sources, almost everything you touch financially generates securities.
Yeah, this is where it really starts to connect the dots in their view.
How so? Give us an example.
Okay, mortgages, big one, right. The materials we looked at describe mortgages as T-notes, like treasury notes often maturing in 30, maybe even 33 years. They're seen as some of the riskiest bonds out there.
Risky T-notes, okay.
And when you get a mortgage, this perspective says it usually involves 3 distinct securities. There's the note itself, then a promissory note, which is commercial paper, remember?
Right.
And then the title to the property. 3 separate things.
3 securities from 1 mortgage.
That's the argument. And the interesting part, they suggest, is that banks can then trade these 3 securities multiple times for profit, making money way beyond just your payments.
Because they've basically turned your promise to pay into tradable assets.
Precisely. They've securitized your obligation.
Wow. Okay. Does it stop at big things like mortgages?
Not according to these sources, no. Think about your bank accounts. Even simple receipts.
My savings account, how?
So your savings account, they say, is treated by the bank like a certificate of deposit, a CB.
Like the kind you invest in.
Sort of, yeah. A CD is basically a time deposit, pays interest, your money's locked up. The sources suggest every dollar you deposit is essentially turned into a CD by the bank.
For how long?
Often with a 2-year maturity period, they say. Maybe as floating rate notes where the interest can change. It allows the bank to earn interest on your deposit beyond what they pay you.
Okay. And receipts, like from the ATM or the grocery store.
Yeah, those two. ATM receipts, bank deposit slips, even store receipts. The sources explain these are also considered commercial paper securities.
Get out.
The store or the bank is, in this framework, essentially issuing a security to you. You're the investor holding their paper, and they can, according to this view, get paid multiple times for that one transaction.
How multiple times?
Well, they get money up front based on the security they issued to you, and then you, the customer, effectively pay them back when you pay your bill or through the transaction itself.
That's a lot to process.
It is. And think about credit rating agencies. Experian, TransUnion, Equifax.
Yeah, they track my credit score, right?
Well, most of us think their main job is rating consumers. But these materials argue their primary function is actually to rate firms, companies, for issuing commercial paper.
Really?
Yeah. Those company ratings determine the interest rates the firms have to pay investors when they issue CP. It's not mainly about your personal score, in this view. The whole system revolves around these commercial entities.
And individual people.
We play a different role, often without realizing it, according to this perspective.
So, just thinking about that. Every time you get a receipt, the argument is you're basically an investor in their CP, holding their security.
And they might be getting paid multiple times over. And this connects back to the national debt, how?
The sources link it by saying the debt is so massive because in this interpretation, we've never claimed our money back. We, the people holding all these receipts and notes, are essentially the lenders, the creditors, and we haven't collected.
We're the lenders. Wow.
And this all loops back to that unsecured nature of most commercial paper they described earlier.
Why is that so critical?
Because the implication is, if a CP isn't backed by specific physical collateral, then the entity's involved.
Oh.
Well, they might not have the straightforward legal right to just repossess your car or foreclose on your home.
If the original deal was treated mainly as commercial paper.
Exactly. It challenges the basic assumptions about ownership and rights in these transactions, according to the specific interpretation. Okay, this is a lot of potentially heavy information. So with all this, what can you actually do, assuming this perspective resonates?
Right, and it's crucial to say this deep dive is purely for educational purposes. It's not legal advice, not financial advice, not tax advice. Definitely talk to qualified professionals before acting on any of these ideas.
Absolutely. Good disclaimer. So what do the sources suggest?
The first big step they emphasize is something called revoking security interest.
Revoking security interest. Why?
The idea is to formally remove an entity's claim on your assets, your car, your house, whatever. This makes their perceived debt in this framework unsecured.
Okay, how would you do that, according to them?
They suggest writing a formal notarized letter stating your revocation. Then you get that notary's signature certified by your county clerk, an extra layer of officialness.
Right.
Then send it via registered mail so you have proof of delivery to the CEO, the CFO, and the legal department of the company or bank involved.
And then what?
They have a limited time, usually 21 days, according to these sources, to contest your revocation in writing. If they don't respond properly within that window, your revocation, according to this method, stands as legally binding truth.
Interesting. What else?
Well, there's this concept they call the 80-20 rule.
80-20.
Yeah. The idea is even if you feel you've been wronged, to keep things lawful and fair within their understanding of the system, you can offer to let them keep 20% of any proceeds recovered.
As payment for their service?
Kind of. For acting as a security transfer agent is the term they use, while you claim the other 80%. It's about acknowledging their role, perceived or real.
Okay. What about those documents stamped copy Y? People see those all the time.
Right. The sources say that copy Y stamp actually confirms an original does exist somewhere.
Which has probably already been sold or traded?
Likely, yes. Sold on the market. But, crucially, they argue that the copy you hold is still considered a security, it still has standing, and you can potentially act on it within this framework.
Got it. Any other practical tips from the sources?
Yes, a big one. Switch from paperless billing back to physical paper statements.
Why is that? Seems counterintuitive today.
Because PDFs and digital records are often just book entries. Their existence is recorded digitally, not as a physical instrument. And the sources suggest these digital forms can be harder to formally use if you're trying to assert your claim as the holder of the security.
So physical paper is key for this approach.
Vital, they say. Also, strategically, they talk about using irrevocable trusts.
Irrevocable, meaning you can't change it once it's set up.
Exactly. The idea is to transfer debt out of your personal name and into the trust. The sources claim such a trust can't be sued for debt in the same way an individual can, and it's considered sort of foreign to domestic corporations.
Offering potential protection under this view.
That's the theory they present, yes. Significant protection.
And the scope of where this applies, it seems really broad based on what you said.
Incredibly broad, according to these sources. Think student loans. They originate from master promissory notes, right?
Yep. Signed a few of those.
Those are considered securities. They even suggest you might be able to file 1099 9C forms for discharged student loan debt based on this.
Wow. What? I know.
Insurance policies, car insurance, renters, even PMI on your mortgage, all categorized as securities in this framework.
Insurance policies, too.
Mm-hmm. Security deposits for rentals, that's your payment, creating a security that generates interest for the landlord or company, pre-approvals for credit cards or loans. Because they state a specific amount, they're considered securities.
Even a pre-approval.
Yes. And even things like child support orders. Because they specify amounts, they're interpreted as creating securities for both parents involved.
It literally touches almost everything financial.
That's the picture painted by these sources. Finally, they advise developing relationships with certain types of brokers.
Like who?
Specifically, they mention 7 series brokers. Those are folks licensed to sell most types of securities or security transfer agents. You find them at places like Fidelity, Charles Schwab, Edward Jones.
Then what would you do with them?
According to the sources, These professionals could potentially help you formally securitize the notes and receipts you hold, and maybe even put them onto primary and secondary markets,
allowing you to potentially get paid for these securities you didn't even know you had.
That's the potential outcome they suggest is possible within this system.
So the overall message here isn't about, like, running away from the financial system.
Not at all.
It's about understanding its rules, at least as these sources interpret them, and potentially making it work for you instead of just, against you.
Exactly. The sources repeatedly emphasize that knowledge is power here. Understanding the language of commercial paper, recognizing your potential role, not just as a debtor, but maybe, just maybe, as the creditor, the lender.
Right, the lender.
Yeah.
Well, today we really pulled back the curtain, didn't we, on commercial paper, Federal Reserve notes, and this idea that almost every transaction might be creating a security from your car note, your phone bill, even those little ATM receipts.
Yeah.
The perspective is you might be sitting on potential assets, not just liabilities.
And it raises a really big question, doesn't it? If the system, as these sources see it, is designed for us to constantly create value for others without us really understanding our position as investors, then how much of what we call collective debt, personal debt, national debt, is actually within this framework our own unclaimed wealth?
Unclaimed wealth. That's a powerful thought to end on.
The next time you hold a bill, a receipt, any financial document, just remember its potential hidden life, according to this view, its potential place in the commercial paper market.
Definitely something to think about. Thank you for joining us on this very deep dive.
Yeah.
Stay curious, keep digging into things.
Absolutely.
And we'll catch you next time with more insights into the hidden mechanics of the world around you.